The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst James Carlisle. Hey, James.
Morning.
And from Vancouver, analyst Graham Whitcomb. Hey, Graham.
Hi, Gaurav.
Well, gents, we've just finished reporting season. At least we've finished the official portion of it. I know we're all trawling through results. I've still got, I reckon, about a half a dozen companies at least, and maybe more to go through. But it seems like a good time to stop and check in about reporting season, see what we've learned, and cover some of the interesting stocks thus far. So, Graham, let's begin with you. What would be, I mean, I know the stock you're going to talk about, but we got to create a bit of mystery for everyone. So which business do you think had a really fascinating result that you can enlighten us about?
It's a very sleepy business, but one where the sleep is often broken by breathing difficulties.
I was hoping there'd be a good sleeping pun in there, and you did it.
That was the best I could come up with. I think ResMed has to take the cake of one of the best results I covered. It wasn't from its own doing, though. The company has benefited mainly from a blunder with its main competitor.
Is that the Philips business?
Yeah. So Philips is its leading competitor. They both used to share about half of the market, or around 40% of the market each. But since then, Philips has had to recall nearly 5.5 million different CPAP machines and ventilators because they found this foam component which didn't. I can't remember. I think it dissolved slightly and released some sort of toxic gas into the machine, which wasn't ideal. They've had to recall everything. But what that's meant is the past year, the company has had to divert all of its manufacturing capacity towards either replacing or fixing these different ventilators and.
So it's an old machine. It's not the current machine that they're selling. It's Or is it the mask?
No, I think it was the current one until they had stopped that and started to replacing the parts.
Right.
Yeah, but what that's meant is that they've had to make an extra 5 million machines, which they weren't able to do while still selling to new customers. So they've essentially just had to sell to all of their existing customers all over again, only for free. So that's been a great benefit to ResMed because Philips hasn't been taking on any new customers for a year. And that's left a huge part of the market just to ResMed because ResMed was already the dominant manufacturer.
Have they been able to match demand with manufacturing capacity? I would have imagined it's pretty hard for them to scale up hugely from there.
That's been the interesting part. It's been a blessing for ResMed either way, but it couldn't have come at a worse time because ResMed and Philips were already having trouble coming out of the pandemic meeting demand because of all these supply chain issues. So backlogs in shipping and all of the rest of it have caused issues in manufacturing. So they weren't able to meet the demand with their existing capacity anyway. And to then have all this excess demand come on from the Philips pulling out of the market has caused, they've definitely left a lot of money on the table, which in a normal year they probably could have taken better advantage of.
Yeah, right. Now, do you think this I'm just looking at the share price. It doesn't look like the share price reacted very much or negatively, if at all, to that news, which I would have thought is quite important. Is that because these kind of recalls don't lead to permanent changes in market share?
Well, the share price reacted when the news was originally released a year ago. So now we're kind of partway through.
Oh, I see. Okay.
The 2 year of the 2 years of extra sales.
Okay.
Yeah, but that's kind of the big question. Is ResMed's currently doing at least probably 50% or more of all new customers are going to ResMed at the moment. All new CPAP customers are going to ResMed, which is, the question is whether they're going to be locked in and it now has a permanent market share of 50%, or whether once Philips gets back online, it's going to give up all of the gains that it had and kind of revert back to a 40% market share or so, which it had before the recall.
Does the sort of brand damage depend? I mean, I guess it's because it's effectively supplied, recommended by doctors. Do doctors, care providers, I should say, actually recommend a specific brand of machine? So that might provide some protection against sort of the brand damage, because they may be more pragmatic in terms of recognizing that they've corrected the mistakes. Or, I mean,
I suspect so, actually. Ultimately, the person, the actual user, is going to be deciding, but taking advice from the doctor or following what their insurer allows. But, I would think that does help Philips a bit, that it's got these gatekeepers, which are hopefully pretty rational and realize that once that foam component's gone, it's not as if the rest of the machine isn't going to work as described.
Well, I've got both of you, because James, you covered ResMed for many years for us as well. One thing I've always wondered about ResMed is that the machine itself, the hardware, is a relatively simple piece of technology. It's basically just a ventilator, right? Like blowing a compressor and a power source that blows air. So it's very easy to replicate. There are no technical hurdles to overcome. So why is it that the entire market is dominated by these two companies? And why hasn't it been inundated with competition, given the really high rates of return on offer?
Bit of science. I think probably it's because it's quite difficult to displace. I mean, it's the sort of, as you say, it's pretty easy, but once you've got a big share of the market, what's the incentive to switch to someone else? You want something that works, which is probably.
Can't you offer it at a lower price? I'm just, because they generate epic returns on capital, huge margins. I'm just surprised that someone else hasn't come in to do it a bit cheaper.
They keep improving. Sorry, I'm probably stealing Graham's thunder, but they keep improving the machines as well. So I think the basic CPAP has pretty basic, simple technology. But as you go up to the sort of variable pressure machines, which I think, I forget the detail, but they respond to the conditions that they find in your throat to deliver differential pressures. Okay. Isn't that right, Graham? So they do get a bit complicated, and I mean, ResMed's now providing all the sort of software platform that goes with it, and so it's all become integrated. They're probably doing the whole platform thing to try to protect themselves against that. But I guess it's just the point about it being difficult to displace the incumbents in this sort of thing, and they've been able to deliver those constant improvements. If they hadn't, then I'm sure they would have been caught up and overtaken pretty quickly.
Great.
So I think it also probably, and I think you're right about the connected care kind of aspect, where it links back to the healthcare provider. I'm sure helps solidify their position. But also, I think because wearing the machine is so uncomfortable, then you're going to put a lot of effort into finding the best. And even if ResMed and Philips are just 5% more comfortable, lead to a tiny bit better compliance, then that can mean that they take a lot of market share compared to the others. And then that gives them more funding for research, which means better masks, which means better smaller machines or whatever. So they can kind of keep the lead. I don't know. I think it's probably lots of little factors.
How important is the role of the gatekeeper here? Because it has to be recommended by the doctor. And we know that the medical industry is famously conservative and hates to switch around. Are they a big part of the moat here?
Yeah, I would think so. It's also been an issue that they can't get people to clinics and get fitted and to get prescriptions and all that kind of stuff during the pandemic. So having a gatekeeper, you probably wouldn't argue it's in their favor over the past couple of years, but it might be in general.
So Graham, what happens now? I mean, the results were sensational. You've got a crippled competitor. You've written about the software integration over recent years as well, which by all accounts is going really well. Why is this not on the buy list?
Just a matter of price. It's not that far off our buy price. Our buy price is $25. The stock's at about $32. So it's undervalued, but yeah, we're happy to give it a bit more room before upgrading.
James, do you own this one? I seem to recall.
No, I did. I sold a bit of a wound. Yeah. Look, I bought it pretty well, so that always makes things
You
better.
bought it like $3 or something,
A bit
wasn't
less,
it? It was
240,
Wow.
250, something like that.
Hang on, but what price did you sell it at?
Oh, look, 6, 7, 8.
Oh, that's all right. You did fine.
Yeah, look, I did
it.
well,
Yeah.
but look, when you think of what could have been, I wish I'd held on to a bit.
That's becoming one of the hardest questions. When to sell is such a tricky question. You hear about all these stories about sitting and holding in for a long time, but there are just as many counterexamples of where you should have just sold once the valuation looked.
Look, it's easy with hindsight, isn't it?
It is.
So,
yes.
look, I think you try to get something. I think at the time I bought it, it was there was a big margin of safety. It looked really very cheap for a high quality business, but. It became quite expensive. I think when I sold, the multiple had gone up quite a lot. So a lot of the value had been recognized, and a lot was being paid forward for continued performance, which they've managed to achieve. So hats off to them. But I was also slightly concerned that that they were beginning to sort of saturate the market. There's only so many people who suffer from sleep apnea. And they were beginning to get to levels where, I felt the growth was running out. But I think I was underestimating their ability to keep improving the product, make add more value, the whole platform thing. They've performed very well, but the original sort of undervaluation, I think, sort of disappeared. And that's, I suppose, why we've mostly had it as a hold for a long period of time. Fortunately, Graham, who took over coverage of it, I think probably just before I can't remember, around the time I was selling myself, and he's managed to hold on to it in terms of our recommendations. So that's good. So it's been a good recommendation. I think we upgraded, I should say, because I bought it when I was having a spell not working for II. That was whenever it was, but so it was 450 odd when I think before we upgraded it first. But
yeah, right.
It's gone pretty well. Yeah.
It has gone pretty well. Yeah. Okay. I might bring up the next stock we want to talk about, which is BHP. I know we talk about this almost every reporting season. The reason I bring this up is partly because the result was sensational. It's right up there with one of the best results of reporting season. And that came as a bit of a surprise. But I also think it's such a bellwether for what's happening in the mining industry more generally. And there are a couple of trends that were evident in BHP that I think that are now growing throughout that industry. So let's just say a little bit about the result first. It was fantastic, and it was fantastic in the face of lower iron ore prices, and that was a surprise. What really kicked it up was the enormous benefit they got from having the world's richest met coal deposits in Queensland. So basically all the price increase came from coal, which now I think it's about a quarter of their profits. I think they went from making a loss of $500 million last year to making, or a small profit, I think actually it was. I'm getting mixed up here. But they made huge profits. A quarter of the entire profit pool came from coal.
Can I just butt in and ask a question, which occurs? So metallurgical coal, right?
Yeah.
I mean, so that's obviously for making steel.
Yeah.
And I mean, the big surge in the coal price I had sort of understood was a sort of because of the whole energy crisis thing. So I'm curious to know how if we're having more of a, slowdown and all that, you'd think that the metallurgical coal price, but are they interchangeable? Can you use, which is more expensive? Would you ever use met coal as thermal coal, or would it be pointless?
You've just asked a very complicated question there. So let's wind back a bit. Yes, so met coal is used in steel production. Thermal coal is power generation. You're right. Thermal coal is the one that's gone bonkers. Traditionally, met coal is probably 2x what thermal coal is, and at the moment, thermal coal
higher quality.
It's much higher quality.
Right.
But at the moment, thermal coal is probably 30% dearer than met coal, maybe more than that.
Wow.
At the moment.
Well, why wouldn't you just burn your metallurgical coal? Is that what people are doing?
You can't quite do that. The boilers that use thermal coal,
they get too hot.
Yeah, I don't know why, but you can't just substitute. There is a coal called PCI, which is pulverized coal injection, which is a met coal, but a different kind of met coal that you can switch into the thermal market, and some producers are doing that. But BHP doesn't have that. BHP has the top-notch tier 1 hard coking coal, which you can't just switch into a boiler and use for power generation. So,
but its price has still responded pretty well.
Yeah, the price is still much higher than historically. It's if we weren't being spoiled by the thermal coal price, everyone would be thrilled by current prices for met coal. So they've done really well out of that. But your point's well taken that that this is famously cyclical and depends on steel margins, and it looks like steel in China is rolling over, and there are you got to wonder about the sustainability of met coal prices at the moment. But the fact remains that no one is adding capacity, and that's the main thing. BHP went out of their way to say we are not allocating $1 of capital to our coal business because they're worried about super taxes coming in, but also I think they're worried about the signal that sends to some of their investors. So that still remains an attractive asset for them. I can't see them ever divesting it because it is by far the best coal asset in the world, and there's nothing like it. So I don't think that they're going to get rid of that. But one of the things I noticed about BHP, and also which is now coming through in the entire mining industry, is the rise of CapEx. So one of the reasons that BHP has been such a phenomenal business over the last 8 to 10 years is just that it stopped spending silly amounts of money on CapEx, and free cash flows have been rampant. At their peak, I think about 10 years ago, they were spending about $20 billion a year on capital expenditure. And in recent years, that's come down to $5 billion a year. And
is that going to leave them a bit exposed? Are they going to get to a point where they're underinvested and they've got
I think we're there, James. Yeah. Right. I think that's absolute. That's the story of the mining industry over the last probably 6-7 years, is that no one's invested enough money in new supply.
But also, what about the existing? Are they going to need the maintenance side of the capex? Have they been doing enough of that?
Yeah, it looks like. There's still $5 billion a year being spent.
So it's just the supply, right? The new supply. Yeah.
Yep, and it's new projects. It's new project. The big dollars are spent on project development, maintenance, and just expanding resources enough to keep your reserves intact. That doesn't cost too much. It's building the new projects that eats up lots of money, and they just have not been doing that. But I think that's ramping up now. They talked about doubling their capex over the next few years. So when all of a sudden we're going from $5 billion of capex to $10 billion in a year or two, and they reckon that's where they're going to stay for a little while. And that's got to do with some new projects they're bringing on board, and that is true for everyone across the industry. Basically, every miner I looked at spoke about higher capex and the need for more projects, and it just got me thinking that we've had this really big, these really huge results from big miners over the last 5 or 6 years, and that might be coming to an end. This little golden period for mining might be coming to an end. It might be time to switch over to looking at some services businesses, because those of companies had a miserable time because of the capex strikes, and I think that with capex numbers now picking up, it might be time to look at services and drillers potentially. Anyway, just an idea. Might be time to look at it. All right, shall we move on from BHP? Anything to add? I know neither of you own it. I know neither of you are ever going to buy it. Just missing out on huge returns, but fine. That's fine.
Yeah, well, I'm just
Who needs them?
It's the Whitehavens. Actually, I didn't mention that. Sorry, we don't want to get you onto that.
Yeah, we're going to try and do a Whitehaven-free podcast today.
All right, let's move on.
JC, what did you bring along?
So look, I can't help myself but talk about Altium.
Oh, of course.
Which of course. Really, as results go, it absolutely...
It was good, wasn't it?
It just... There was barely a weakness. I suppose the one weakness, if you had to pick something out, would be that a lot of the growth. So it smashed the forecasts and guidance and all that. And a large part of that was due to this Octopart business, which it bought, it's 2016, 2015, something like that. And I think revenues pretty much, I think it's increased tenfold in that time. But volumes in the business, and I think probably revenues, I'm just trying to think about, but doubled in the year, because everyone's, there's the supply chain problems, component shortages, everyone's desperate to get their hands on things. And so search volumes in Octopart have doubled, and that's going to be very helpful. And the click.
Can you just explain for people who might not know? Just explain what Octopart is within.
Well, it's basically a search engine for finding components.
Is it like a catalog, right?
Online.
That's the way I think about it.
Yeah, I think so. But it's I think it brings together a bunch of catalogs. Look, I'm afraid I don't use it. So, but it's a means of searching available. I think suppliers submit their supply to it, and what it delivers is clicks through to components, and it gets revenue by charging for those click-throughs.
Okay.
And the click-through rate remained relatively stable, but the volumes doubled. So actually, I'm just looking now. So 76% rise in revenue for Octopart, and of course that's not really repeatable. So the main engine of the earnings beat, as they call it, is probably not repeatable. I think they think it's going to have an all right year, but it's not going to double. But the other side of that is that, and this was the really strong part of the result, is that it demonstrates, it's come at a perfect time, this supply chain crisis, because this is what Altium's trying to do. They're trying to build this platform. And that's really the investment case. They're putting together a platform because they just make the software that helps people design printed circuit boards. But that puts them in a unique position to build a platform so that manufacturers, product designers can look at they can all integrate over the making of it. So if you think about wearables like a Fitbit or an Apple Watch or whatever, the componentry that goes inside that has to fit. It has to possibly even be shaped a certain way. It has to have certain heat dissipation characteristics. So lots more people than just the PCB designers need to be involved in that process, and they need to collaborate. So Altium's basically building up this platform for people to do that. And one of the elements of that is that while you're designing your PCB, you can decide to put a capacitor in, and then you'll find that capacitor's not available. And so, Octopart will be able to show you what other capacitors are available, and you can put that capacitor in, and it may be that you then need a slightly bigger resistor or something. But you can build your product based on what's available, what and the current pricing is,
can see what you're
and everyone
doing.
Can see what you've put in, real time.
Fantastic product, really.
Yeah, so that's the platform side of things that's just developing. So they're not really charging for that at the moment. They certainly are charging for Octopart, but they're for that platform's just developing. They're going to monetize it directly eventually, but it's also driving sort of upselling of their core product. So more people are now subscribing to the sort of premium software, design software, from the basic, upgrading from the basic standard Altium Designer subscription, because they have the greater platform capacities. Right. They integrate better with the platforms, and people are just increasingly needing that. So other little data points, the number of users per account increased, which Aaron Merkazemi was saying he believes reflects the fact that more different types of users outside their traditional user base are using the products. And so the average revenue per seat is increasing, which is always good to see. As a result, so guidance for the next year is higher than anyone was expecting, but also that big target of around $500 million in revenue by 2026, the aspirational target, which has been much talked about, and everyone's assumed they're never going to make it. But they came out and they said that they thought they probably would make it. And what's more, they no longer need. Previously, they've been saying they needed a contribution of 10 or 20%, I think it is, or so, from acquisitions. They now think that they can probably make that without that. They also now think they can. So they also have 100,000 seat target for 2026, where they're currently in the mid 50s. But they came out and they said, look, we probably think we can get to our 500 million probably with only, I think it's 75 or 80,000, 75 to 90,000 seats, I think, because of the higher revenue now that they're seeing per user, because people are using the premium products more. So really, the result demonstrated, it just gave a lot of confidence in this whole platform approach that the company's taking, where previously people have been sort of in a wait and see sort of mood around it, and but now it's really looking like it's beginning to happen, and that's why I think the stock jumped 20% on the day, didn't it, as a result? Wow. So that pushed it past our buy price. So we've shifted it down to a hold, but it's a very, very comfortable hold. Still quite expensive, but with very strong growth prospects and a very high quality business underneath. So
if they pull off this platform trick, it could be worth a lot more than it is today, right?
Yeah, I mean, look, it's it's dangerous to make these sorts of pretty. I mean, it's very hard to say, really.
Oh, come on, get excited, James! It's pretty amazing.
Look, I think the key point about it is that it's really the length of their growth runway that it changes. It gives the whole platform then gives confidence that they can grow at elevated rates for a very long time. And that's what makes the difference to the valuation. If compounding, most people sort of factor in after 5 or 10 years. I think it was Altium. I actually saw a broker DCF. They were valuing it based on a DCF, which said that it reverted to 3% growth in 10 years' time.
Right.
And look, if half the market's doing that, you're going to get an undervalued stock, because I mean, look, I just don't think that's a likely outcome. I couldn't tell you what the growth's going to be for the next 10 years, but I'm pretty confident that after 10 years, it's going to be growing at well above 3%. And, if you go 10, 20 years, I mean, look, that's what you're paying for. You're paying for a little slice of that opportunity, which could keep compounding for a long, long time. Because they could be, he's talked in the past about becoming the Adobe Acrobat of, PCB, well, of the design, it's not just PCB design software, but the other add-ons that they can monetize as well, like Octopart, potentially manufacturing, that sort of thing.
Nice.
So I'm excited, but it is now 20% more expensive than before the result. And, that's, I think we've had good opportunities to buy it, so I think now's the time to pause, and we'll see how that goes. It's certainly not
sit
cheap.
back for 10 years
or 20.
Yeah, no, the CEO is an interesting figure. I know he's got the runs on the board, and I use that analogy very deliberately because he really put me off last time with all these sporting analogies, and
I love him. You got to love a good eccentric. I mean, he's
eccentric. Yes,
he's pretty crazy. But you look at his, what he's done, and I can't even. I couldn't tell you what country he even.
He's from Iran, isn't he?
Yes, I think he is. Yes, that's right. And he couldn't speak English when he arrived.
Yes, that's right. An amazing story.
And he did engineering because he could do that without speaking English. and he still got top marks. And and then he set up this company, and it got bought by Altium. And so look, he's got an amazing background, and he's very, very smart, I think. And he has big aspirations, and he talks it big, which can be a bit off-putting at times. But, maybe you need that kind of, brashness, optimism, whatever you want to call it. That's possibly what drives a business like this forward. He's, you've got to keep the ball rolling, and he does that. And I think that he's doing the right things. I think they do have this unique opportunity to build a platform for designing electronic products.
Yeah.
So I'm looking forward to that.
Yeah, look, I can't argue with any of that. The business is amazing. He's done a fantastic job. I don't own it, and I guess I've probably just preferred other opportunities. I think it's a company I probably would buy at some stage, but I just haven't yet.
Yeah, look, it's expensive. I mean, but you've got to take your opportunities. It got down to $25.
Yes. At that price,
a couple of months
it is
ago, and I think it was looking pretty good there.
Yep.
I'm just looking at the current PE is about for this year is about 50 times earnings. So it comes down to on broker forecast for what they're worth, but it comes down to 32 for 2 years forward. But that's high quality earnings in as much as they don't capitalize R&D. So it's a pretty clean, that it comes through pretty well as cash. And if a lot of that money is being spent on development and a lot of the costs. So if you capitalize some of that, possibly you'd get a lower P. But the key point is that it comes down quickly. And I think it'll keep coming down, if you see what I mean, based on today's price.
I'm not supposed to mention this, but it's hard to view that as that attractive when an alternative investment gives you an 80% free cash flow yield.
Well, you say that, but all right. In 20 years' time, we'll sit back and we'll tally up our Altiums versus our Whitehaven goals.
We don't have to own stocks for 20 years.
But you have to value them on that basis, and then at some point someone else will come along and realize some of that, and take the stock off you. But I mean, the value of the stock is determined by the cash flows it can deliver over now till infinity.
Yeah. Well, we need.
I'm not arguing with what. I mean, look, I'm not in a position to argue with those, but they deliver their cash right here and right now, and then possibly fizzle out in 5 or 10 years. There's nothing wrong with that. Yeah. But this is a different type of investment, and who knows who will end up ahead.
I see your Altium, and I will raise you Lovisa, which I think was another standout result of the season. And I got to say, I was surprised by the share price move because I would have thought that it was pretty obvious that the numbers were going to be really good, that it was heavily impacted by COVID, and that the problems they had over the last 2 years would turn around. They'd been building up this store network even through COVID. They'd added something like 60 territories, 60 new stores in a handful of new territories in Europe, and all those came together. They've got plenty of growth in new countries, and if you look through their result carefully, they've registered their name in a handful of territories they've never had before, so including Hong Kong. So there's a whole bunch of growth coming through, and I think the market just stood up and took notice for the first time in 2 years, because the stock price was up 20% on the day, and it has kept climbing ever since. And I think it's up now sort of 50% in a week or something like that. And wow. that tells you that the market had this thing totally wrong. And I'm just surprised that I'm surprised by the extent of the move, even though the result was very, very good. Now we've had a buy on Lovisa for some time. It's been a hold. It went down to the buy price very briefly for a couple of days only. Didn't quite get a chance to upgrade it for a couple of days, but yeah, that opportunity has has flown by, and I think now we've got to think about, everyone's getting very excited. At what point do we start taking profits on the business? That's where I'm at on it.
Why wouldn't someone just copy the concept and add their own kind of clone of the store right next door?
Yeah, it looks like a very simple business, doesn't it? I mean, they sell cheap jewelry to teenage girls mostly, and I guess older women as well. But the fast fashion concept is really important. So it means that they're fully integrated from the design stage to the retail stage. So they design, manufacture, distribute, and then retail. And all throughout that chain, there are just really important feedback loops. So they get the data from the sales and from a network of hundreds of stores. All that data is accumulated and analyzed, and they can see from that data what designs are working and which designs aren't, and they can send that information back to the design stage, and they can change their designs, ramp up or ramp down at the manufacturing stage, depending on what's popular and what's not. So there's just really good feedback loops throughout that entire business, and it just means they can optimize really, really well. So they can follow a trend, they can recognize new trends, they can stop stuff that isn't working, they can ramp it down when the fad is finished, and they do all that really, really fast. I think the turnaround time from concept to retail design is, I think it's like 4 weeks or something like that. Like, it's really, really fast. They get stuff out really, really quickly, and that's really difficult to compete with. If you're a new business or even an established one, you won't have the same data as they have. You won't have the same knowledge about what's trending and what's not. It's very hard to compete with. So
the thing that's always kept me away from it, aside from the fact that it's a retailer, and I've got a thing about those. But how much of that is down to people? They've particularly, I think, had a very good buyer, haven't they? Haven't they got a buyer who's very well regarded? I thought, or
a buyer?
I think. The person sourcing. I mean, because they're not just, as you've just been explaining, they're not just the buyer; they're also the person involved in that whole design. The person who sources the products, essentially, a person in charge of doing all of what you've just been describing. How much of that is a corporate advantage, and how much of that is down to having the right person, which you then have to pay a lot of profit to keep if they threaten to go away and do it for themselves somewhere. I mean, that would be my sort of worry, is that if they decide to leave for whatever reason, then you're left not doing it quite so well, are you?
Yeah, no, it's a good thing to worry about. If you remember, what's the name of that business? Oraton, probably about a decade ago.
Yeah.
They had a really good combination CEO and chief designer, these two young people who came in, refreshed the business, and it was sailing. And when both of those left, the business kind of fell apart, and it was taken over cheaply out of administration from memory. So that was clearly a case, as so much retail is, of brilliant individuals running the show. I think that's less the case here. I mean, I think Lovisa does have fantastic management and really good designers and clearly really good retail people who get the right stores in the right places. But because so much of the design is informed by the sales data coming in, I think it's less at risk of brilliant individuals than it is a system that is tweaked and just gives off a lot of clues about what's working.
So they do have the data. Yeah,
I think they have a system,
and they make good use of that, right?
I was trying to think about the logistics of this. The sheer I think they do about. Oh, yeah, geez, you're testing me here. I've gone through so many numbers in the last few weeks, but I think they do 100 or 200 new pieces a week. And they ship that out to a store network of sort of 500, growing rapidly. And they last year they opened about 100 stores. And just think about the logistics and the management and everything that's required to get all that done. This is a really well-oiled machine. Not only the numbers incredible, but the way everything just seamlessly works to make this really high inventory turn model work is phenomenal. You're right to the extent that the whole thing is dependent on fantastic management. It's not as if you're putting something on the shelf and just waiting for someone to take it off. You really have to turn this inventory over really, really fast. And that's a challenge for everyone. But even without brilliant management, you still have a system there that's feeding you lots of clues.
Yeah, and it's not necessarily dependent on, one or two individuals.
Well, you only find that out once those one or two individuals leave.
That's right. That's right.
But I'm pretty comfortable with it. It's been I've held it for years. I think this is a fantastic retailer. It's probably the best numerical new retailer I've ever seen. I remember when we first looking at it internally, right? We're all in awe about these numbers. We just couldn't believe it.
Yeah, I'm very happy to say. Look, of the discretionary type retailers, I'm very happy to say it's as good as any, isn't it?
Yeah.
I suppose JB Hi-Fi would have a word about that, but I don't think JB Hi-Fi produces anything like the return on capital and that sort of thing.
That's right. Although, JB Hi-Fi is no doubt a wonderful business. I was also going to go to Bunnings as just.
Bunnings, but I would put Bunnings in more in the non-discretionary sort of capacity. Those are obviously, and the Woolworths and the Coles, they're obviously fantastic businesses too, but in a very different sort of way. Yeah.
So, Graham, you don't own Lovisa?
I don't, no. But you definitely make a good case for it. I remember the original session being, where we all had to put down our guesses of what the numbers would be, and it was just everyone was wildly off.
I knew it was I actually had a sneaking suspicion about what they were going to be like, but I was still half what they I think were. So, it was.
we were so off.
But
I think the question has always been: is this a fad that's popular now and that will eventually fizzle out? But just women
wearing jewellery. And people in fact wearing jewellery, I should say, is I think definitely not a fad.
That's right.
And so there, however that market develops, and I think that people do want to wear lots of new different bits rather than the same old necklace time and time again. I think that's I suppose the key thing that's possibly changed since 50 years ago. But I don't see that the reason that's changed. Geez, I can't believe I'm putting forward my opinions about
jewelry. Please, yes, tell us. Why?
I think it just wasn't possible 50 years ago. Is the point, is it? And Lovisa and their like, if there is such a thing, have made it possible. And I think it's a thing that is people obviously would want to do.
Well, I think it's happened on both sides, right? Fast fashion, really quick supply chains, tech that allows you to design and produce super fast on the supply side. And then on the demand side, you've got this kind of social media inspired wave of fashion that demands you change your look a lot. And I think both of those things are relatively new.
Yeah, that's right.
And the business depends heavily on both of them, for that matter. But look, we can talk about pretty costume jewelry all day, gentlemen. But we had better call time on the podcast. I've still got so many results to go through. Yeah, you guys finished, or are you still going?
No, I've still got quite a few.
I've got several.
Yeah. Okay. Well, we better get back to it then. Thanks very much for joining me, Graham.
Thank you.
And James, very nice to hear from you. Good of you to join us.
Been a pleasure. Sorry, I was late.
I say that with tongue in cheek.
Sorry, I was late.
Yeah, because he was very late today for the podcast.
First time ever.
Yeah, you're right. It's usually me that's very late. Right, yeah. So I'm enjoying that fact that I was on time today. All right, and for everyone else, thank you for listening.